Okay, if you've been watching the real estate headlines, you've probably seen a lot of worry, a lot of noise. But what if all that static is actually hiding one of the biggest multifamily investment opportunities we've seen in a decade? Today, we're going to cut through that noise, focus on the real signal, and talk about what's coming. Let's get right into it.
But before we dive headfirst into 2026, let's just take a step back. It is so important to remember why we're even talking about multifamily in the first place. This has always been a cornerstone asset class, something people value for its stability. And it's that proven, long-term strength that makes the short-term disruption we're about to walk through so incredibly compelling.
All right, here's the game plan. We're going to start by looking at the current market headwinds. Then, we'll pinpoint the single biggest catalyst that's changing everything. After that, we'll show you how that chaos creates a true buyer's market, lay out a strategic playbook, and then we'll circle right back to why the long-term story for multifamily is as strong as ever.
First things first, let's be totally realistic and just acknowledge what's happening on the ground right now. The market is absolutely at an inflection point, and before we can really appreciate the opportunity, we have to understand the headwinds that are creating it.
So you're starting to see some clear signs of stress in the capital markets. Delinquency rates for commercial mortgage-backed securities, CMBS, they're taking up. And look, while multifamily has held up pretty well, it's not totally immune to this pressure. It's a loud and clear signal that the era of easy money, that's officially over.
At the exact same time, you've got this record-breaking wave of new supply just hitting the market, and this is a classic double-edged sword, right? On one hand, it's great because it's meeting some really strong renter demand, but on the other, this flood of new units is creating some fierce competition, and that's putting a lid on rents and a real squeeze on occupancy.
And here it is. This is the direct result of all that supply pressure. After years of watching rents climb like a rocket, growth has essentially flatlined across the country. This is a huge, huge shift, and it's a massive problem for any owner whose entire business plan was counting on that aggressive rent growth just continuing on forever. So here's the key point, and you've really got to get this. We can't just see these challenges as a downturn. As Jay Parsons puts it so well, this is a transition year. It's an inflection point where the old market rules are giving way to the new. And it's this very transition that is creating the perfect setup for the opportunity that's just around the corner.
Okay, so if those are the headwinds, what's the real engine behind this whole thing? What's the main event? Well, it's not the new supply, and it's not really about stalling rents. The single biggest catalyst that is driving this entire opportunity. It's all happening in the debt markets.
Just look at this number. By the end of 2026, over $1.5 trillion in commercial real estate debt is coming due. That is a staggering amount of capital that has to be refinanced. And remember, a lot of this was borrowed in a completely different world, a world of practically zero interest rates.
And this slide just perfectly lays out the brutal trap that so many owners are facing. They are being forced to refinance into a much, much higher interest rate environment, which puts an incredible amount of pressure on their cash flow. And they're doing this on properties whose values may have actually gone down because of those same high rates. It's a recipe for a massive capital shortfall.
And this chart, wow, this really puts the scale of the problem into perspective, specifically for us in the multifamily world. You can see maturities are jumping by more than 50% in just 1 year, from about $104 billion in 2025 to over $162 billion in 2026. That is not a gentle slope. That is a cliff.
And this, right here, is the core of our thesis today. That immense pressure that's being put on existing owners, that is precisely what is going to unlock a generational buying opportunity for investors who are well-capitalized and patient.
So you have to ask the critical question, right? What happens when an owner is staring down that maturity cliff and they can't find a lender to cover the full loan? Or they can't just write a check for millions in new equity to bridge that gap? What happens then?
It leads directly to this, a true buyer's market. We are talking about motivated sellers who need to make a deal, which means more favorable pricing for us. It means higher quality assets are going to come to market. You're going to get better day one returns, and crucially, there will be way less competition from all the over-leveraged players. For those of us with capital ready to go, this is the environment we have been waiting for.
And this is the part that really gets me excited. The assets we expect to see come up for sale, these aren't just struggling properties in some fringe locations. No way. We are talking about high-quality, well-located apartment buildings that are only for sale because their capital structure is broken, not the asset itself. These are the kinds of deals you just could not find 2 or 3 years ago, no matter how hard you looked.
Okay, so the opportunity is clear. The window is opening. But capitalizing on it, that takes a disciplined, proactive strategy. This isn't about getting lucky. This is about being prepared.
So here is the 4-point playbook. Number 1, cash is king. Get your financing and your capital lined up now. Second, diligence is everything. You have to scrutinize every single deal based on its real, underlying fundamentals, not what it did in the past. Third, and this is important, don't try to perfectly time the bottom. Start deploying capital as these opportunities pop up over the next 18 months. And finally, number 4, you've got to stay flexible. The market's going to shift, and the best plans are the ones that can adapt.
Now, as we navigate all this dislocation, it is so vital that we don't lose sight of the bigger picture. What we're talking about here is a temporary market condition. It's not some permanent flaw in the asset class. The long-term fundamentals of multifamily are, believe it or not, stronger than ever.
I mean, the historical data makes this case so powerfully. If you look back over the last 30 years, a portfolio that strategically allocated just 20% to multifamily significantly outperformed a traditional 60-40 stock and bond portfolio. And this isn't just about getting higher returns, it's about diversification and resilience through market cycles, which is exactly what we're seeing play out today.
So let's bring it all home. The dislocation that we've just walked through today, it isn't a crisis, it's a clearing. For prepared investors, it is a rare window to acquire fantastic cornerstone assets at reset prices. This is how you set the foundation for outsized returns for the next decade. The opportunity is coming. The only question is, will you be ready to act?